One wire.
If I can have your attention. My name is Ed Burwell. I'm the Senior Media Officer for Exxon Corporation. Dave Dixon, who is the Media Relations Manager for Mobil, is with me here today. Dave, will you please stand up? Dave will be, will you be around afterwards for a minute? Okay. As you know, Exxon and Mobil today signed a definitive agreement to merge the two companies. Mr. Raymond and Mr. Noto are here today for the next hour to give you further information regarding the merger agreement. After this presentation, we will open the floor to questions and we will open the teleconference to questions. Information that will be presented relating to demand growth, future production, project startups, and future spending represent a forward-looking statement of management's plans and objectives for these operations. Actual results could differ materially from such plans as a result of actual demand, project advancement, and cost estimates. One other point I would like to mention before we start the presentation. Due to federal securities law, Exxon and Mobil will limit their comments on the merger agreement after the expiration of a 48-hour window period. As a result, we really need to have you ask your questions during this 48-hour period. After the 48-hour period ends, we will be unable to respond to new questions and to further requests for interviews until after the prospectus is published. At this time, I would like to turn the program over to Mr. Raymond.
Good afternoon. I welcome all of you to today's meeting, including those here in person as well as those listening via teleconference, the World Wide Web, and the live satellite broadcast. Before commenting on the merger, I'd like to address three important groups: our shareholders, our employees, and our customers. First, I look forward to Mobil's 600,000 shareholders joining the more than 1.4 million from Exxon. We are committed to managing ExxonMobil to create additional shareholder value for the more than 2 million combined shareholders. That has been both Exxon and Mobil's long-standing objective, and it provides the key rationale for our merger. Exxon's success results from our employees' commitment and hard work. Based on competitive interactions over the years, I know that Mobil's employees share those same characteristics. I am confident the combination of Exxon and Mobil employees will allow us to create additional shareholder value beyond that which either company could have done on its own. To ExxonMobil's base of customers worldwide, the merged operations will continue to provide you with high-quality products and services. Because of ExxonMobil's increased resources, we will be able to develop new products and services to meet your continuously changing needs at the most competitive prices. Today, I plan to cover 5 topics. First, the key terms of the merger agreement that Lou and I signed this morning after overwhelming approval by our boards. Second, the business rationale for the merger. Third, an overview of the combined Exxon and Mobil businesses. Fourth, the ultimate goal of the merger. And lastly, some concluding remarks, including a likely timetable. To determine the relative ownership of the Exxon and Mobil shareholders, we took into account a large number of financial and operating factors: income, cash flow, reserves, sales, production, refining capability, market sales, market shares, on both a historical and a prospective basis, as well as relative stock prices over varying time periods. We concluded that an ownership split of 70-30 between Exxon and Mobil shareholders in the merged company would be appropriate and fair to both groups of shareholders. And we also concluded that single-day prices were not particularly useful. This results in a share exchange ratio of 1.32015. That is to say, Mobil shareholders will receive 1.32015 Exxon shares for each Mobil share they own on the closing date. In terms of recent stock prices, this represents a premium in the mid to high teens, in line with mergers of comparable value and relative size of the two parties, recognizing that the premium typically increases with the relative size of the larger company. To be clear, by premium I mean the share of ownership in the new company that Mobil has versus what they had before the merger. The new company will be known as Exxon Mobil and will retain both strong brands. We will be organized on a functional basis with global upstream, downstream, and chemicals business units. Our corporate headquarters will continue to be in Irving, Texas. The headquarters of the worldwide downstream business will be located in Fairfax, Virginia. The headquarters of the worldwide upstream and chemical business units will be located in Houston, Texas. In terms of the board, I will be chairman of the new company, CEO, and will be around until I retire at 65. Lou Noto will be vice chairman. He and I have adjacent offices in Irving. I have great admiration for Lou, having known him for a long time, both as a competitor and having worked with him closely in many industry associations, and of course in more recent days in negotiating the merger. Lou, I look forward to working together with you and the other people in Mobil to make this merger successful and rewarding to all of our stakeholders. Gene Renna will join our 3 senior vice presidents in Irving and become a director. He will assume responsibility for the downstream, while Harry Longwell and Renee DeHaan will be responsible for the upstream and chemicals businesses, respectively. 4 Mobil non-employee directors will also join the new board, bringing the total to 19. As indicated in the press release, the merger agreement contains mutual termination fees payable under certain circumstances if the deal is not completed. In addition, Exxon has received an option to acquire Mobil shares also under certain defined circumstances. The merger will be accounted for on a pooling of interest basis. Also, as noted in the press release, because of this transaction and the requirements of pooling, we are reducing our Treasury share purchases to the amount needed to offset shares required for options and employee plans. Now to the rationale for the merger. First, it is important to note that both companies share a large number of common values, and on a standalone basis, each has positive prospects for the future. In looking at this chart, it strikes me that Lou and I could use the same identical points to describe our companies. With this in mind, we were able to approach the question of a possible merger from a position of strength on both sides. First and foremost, Exxon and Mobil share a common resolve to maintain the highest standards for safety, health, and the environment. Both companies have a long-term commitment to creating shareholder value, a history of strong performance based on efficiency and capital productivity, and leadership positions in key businesses. Additionally, we each benefit from functionally and geographically diverse operations, with strong positions in future growth areas. If you look at our individual business plans, you notice that both Exxon and Mobil have a lot of opportunities to develop. And most importantly, we think we have the high-quality people to get the job done. This past June, when Lou and I first met, we asked ourselves, given the positive outlooks for our individual businesses, was there an advantage to our shareholders to combine the two companies? Could we create more shareholder value together than each of the companies was likely to do on their own? After lots of deliberation and thought, we concluded the answer was yes. There are some very clear advantages. While Exxon and Mobil both have functionally and geographically diverse businesses, the merger will strengthen Exxon's business portfolio in a number of important areas. As I go through the functional overview later, you will see several additions to our portfolio. Mobil's LNG position strengthens our own natural gas business. Mobil is a well-known finished lubes marketer, complementing our solid manufacturing base. Our chemical business will be strengthened. And Mobil also brings important upstream positions in places like Indonesia, Qatar, the Caspian, and Eastern Canada. In Africa, we'll combine a strong upstream portfolio with a leading position in the downstream. The merger will also allow us to compete more effectively with the recently combined multinational oil companies and the very large state-owned oil companies who are rapidly expanding outside their home base, both geographically and functionally. The merged company's larger resources, financial, technological, and human, will increase our ability to participate in more of the new opportunities in the global oil and chemical business. As many of you know, I have never been in favor of bigness for bigness' sake alone. But there are clearly benefits to having this broader resource base. These are important reasons for a merger, but the real prize is enhanced shareholder value realized through business synergies. These synergy benefits come as a result of the merger and would not be available to either Exxon or Mobil individually. Said another way, this is a case of the whole being greater than the sum of the parts. Anticipated benefits can be broadly grouped into two categories: near-term synergies and capital productivity steps. We expect to achieve about $2.8 billion in annual synergies by year 3 of the merger. About 1/3 of these benefits should be realized in the first year. These come from a diverse set of initiatives ranging from organizational efficiencies to improved molecule management. They include cost savings as well as enhancement to revenues. The new company will also benefit by having a larger, more diverse asset base. This will provide enhanced opportunities for profitable growth and a wealth of opportunities to optimize capital productivity. Combined with expected cost savings, these should result in higher returns on capital for the combined business. I'll come back later to these points in more detail, but I'll emphasize here that while the $2.8 billion in near-term synergies are significant, it's the opportunity to enhance the capital productivity of our combined business that drives the merger rationale longer term. With that, I'll provide a functional overview of ExxonMobil. We've included a reasonable amount of detail on these charts, assuming that you might use them as a resource document. In the interest of time, I'll move right along so we can get to your questions. This chart indicates the worldwide scope of the merged company, including key parameters for measuring the upstream, downstream, and chemicals businesses. ExxonMobil will be a top competitor among the international majors in each of these functional businesses and should be well represented in key regions and markets around the world. As noted on the column at right, however, the combination will represent a fairly modest % of the global business in most functional areas. Now to the upstream. The ExxonMobil upstream portfolio will be very attractive. Some of the combined statistics are reflected on this chart. Our position in the key resource area of the world today, including West Africa, the Caspian, South America, Russia, and Eastern Canada, will be very complementary and will offer a total potential in excess of 20 billion barrels. Liquids will continue to be important, making up more than half of the 65 billion barrels in the discovered resource base. Longer term, the potential may even be greater for natural gas, with 175 trillion cubic feet of discovered gas resources, close proximity to the world's primary demand areas, and our combined technologies. Mobil's LNG experience and Exxon's proprietary gas-to-liquids and high-strength steel technologies should help position ExxonMobil to be an efficient, low-cost supplier. Upstream unit costs will decrease as we apply respective best operating practices, and given the large asset base, we will have numerous opportunities to high-grade and maximize the value of our capital investments. Our combined technologies will offer strategic advantages. Exxon's experience in the deep water, our shared expertise in the heavy oil and Arctic arenas, and the previously mentioned opportunities with respect to gas commercialization will be particularly valuable. Talented people, our combined experience, and other strengths will make us the partner of choice for host governments. In the downstream, Exxon and Mobil together will benefit from worldwide brand recognition and world-scale efficient refining capacity. The new company will be well represented throughout the world. Only a few countries will not have any refining or marketing presence of some form. In North America, ExxonMobil will have sales of over 3.3 million barrels a day and 12 refineries. In Europe, sales are just about 2 million barrels a day and there are 10 refineries. Asia Pacific is similar. I should note that the fuels assets of our volumes from the BP Mobil Alliance in Europe have been included. Worldwide sales are 8.1 million barrels a day, or roughly 11% of total consumption. Automotive fuels will be retailed through ExxonMobil's service station network of some 48,000 stores. More importantly, the combination of two experienced and efficient marketers will enable the new company to adopt the best practices of both to compete effectively in this rapidly changing segment of the business. The refining circuit, shown by the dots on the map, matches up well against the best of competition in areas such as efficiency and upgrading. In particular, many are capable of processing low-cost sour crudes through deep conversion, providing significant margin uplift potential. 15 of the 41 refineries are integrated with large lubes or chemicals facilities. Many others have associated chemical facilities, but on a much smaller scale. This integration will be a key feature of the combined operations. Lubes in particular will provide a good fit between Exxon's industry-leading base stock capacity and Mobil's synthetic lubricants and worldwide marketing expertise. In chemicals, Exxon for many years earned a higher return on its assets than the chemical operations of other oil companies. This leadership position should be maintained with the addition of Mobil's chemical operations, which lines up quite well with Exxon's business mix. On a worldwide basis, the combined olefin manufacturing facilities will give ExxonMobil more capacity than any of its competitor group. The same applies to combined polyethylene and polypropylene capacity, and with Exxon's recent Rotterdam expansion, paraxylene capacity will also be the world's largest. We anticipate that the common focus on efficiency, use of advantaged feedstocks, and in particular integrating fuels and chemical operations in one site, which Exxon has emphasized for many years, will improve overall performance. Sharing proprietary technologies and best practices will bring immediate gains, whether from debottleneckings, process enhancements, or operating improvements. The compatibility of the two companies and their similar business mix should allow for rapid integration of the businesses into a single unit. Both Exxon and Mobil have shared similar beliefs about the importance of strong research and development programs focused on the development of leading-edge technologies. This merger brings together two of the industry's strongest portfolios of proprietary technologies with significant current and prospective commercial opportunities. In the upstream, some of the areas where the new company will benefit from integration are deep water and Arctic technologies, heavy oil capability, gas to liquids mentioned earlier, LNG, and high-strength steel. In the downstream in chemicals, there is an even longer list of synergistic capabilities, ranging from catalysis in general, to fuels and chemicals processes, to synthetic lubes and metallocene catalyst advances. Overall, the technology combination should provide important near-term improvement as knowledge is shared between our research units and redundant programs are eliminated. We will also benefit from having a much larger business to support the cost of continuing a focused R&D program to develop proprietary technology. With that brief overview of the business, let's now turn to the financial incentives, or the goal, for successfully integrating the two companies. As I noted earlier, the merger incentives include near-term efficiencies and the opportunity to significantly improve capital productivity. We've included this chart for historical perspective to emphasize that these identified incentives are well aligned with the long-term strategies employed by both Exxon and Mobil. These are the returns on capital employed for both companies over the past 5 years. Exxon has set the pace for the industry in this critical measure, while Mobil has made steady improvement. Strong ROCE performance requires a relentless commitment to being the most efficient competitor in each business segment. It also requires a disciplined approach to capital investment and an ongoing asset management program to ensure that capital productivity is maximized. I believe the investment community recognizes both companies' long-standing commitment and progress towards improved return performance. These ingrained philosophies will be hallmarks of the new company. Ultimately, we think the true value of the merger will be evident here as we manage the combined assets to produce returns higher than either company could achieve on a standalone basis. This chart provides some additional detail for the $2.8 billion in annual cost savings and revenue enhancements available as a result of synergies between the businesses. Organizational efficiencies and elimination of the redundant operations and programs represent about 2/3 of the opportunity. Other identified synergy credits come from a high-graded exploration program and the use of shared best practices across our worldwide operations. We also expect to benefit significantly by optimizing procurement activities and by capturing additional synergies across our extensive supply, refining, and chemicals network. While some of the annual benefits will be realized early on, we expect these incentives to ramp up over the first 2 years, with the full value realized by year 3. At the bottom of the chart, we've noted that the costs associated with implementing the merger are anticipated to be about $2 billion spread over the first 2 years. On a net basis, the earnings impact should be neutral in the first year and somewhat accretive in year 2. Or said another way, if you exclude the one-time cost impacts of the merger, it is accretive from year 1. As I mentioned at the outset, while these near-term incentives are important, It's the opportunity to improve capital productivity that drives the merger rationale longer term, and this is a long-term business. A key objective here will be to high-grade the existing portfolio of assets. Exxon has a strong track record for asset management, including a commitment to improving the performance of underachieving assets or divesting where necessary. This entails a systematic and disciplined management approach in which each asset or grouping of assets is routinely subjected to a rigorous evaluation of current and future prospects under a wide range of conditions. With combined capital employed of almost $80 billion, past experience would suggest there is plenty of scope for an active asset management program in discrete steps over a period of years. Similarly, looking to the future, we expect to benefit from enhanced investment selectivity, which should allow us to achieve comparable or higher earnings contributions from a lower annual CapEx than the two companies could realize on a standalone basis. At roughly $15 billion per year currently, a 10% reduction, for instance, would equate to about $1.5 billion in annual CapEx reductions. I believe this to be a realistic objective. Most importantly, by virtue of our enhanced global representation in resource-rich upstream areas and high-growth markets and businesses worldwide, Exxon Mobil will be in the position to choose from a portfolio of investment options that will be unsurpassed in this industry. That leads me to this chart, which is a graphical depiction of the expected goal. While it's impossible to predict the absolute level of return performance in the future, we do expect returns for the combined business to be higher on a relative basis than either Mobil or Exxon could achieve standalone. The left box indicates the ROCE relationship between Exxon and Mobil on a standalone basis prior to the merger. The Exxon bar represents the base, with Mobil about 3 points below. On a pro forma weighted average basis, the combination would, before synergies, have an ROCE about 1 point below Exxon's. The right box shows the targeted ROCE growth resulting from the business combination. You'll note that by year 3, we expect to see the full impact of identified near-term synergies, while capital productivity steps continue to add value beyond that point. By year 5, we would expect the ROCE of ExxonMobil to be 3 or more points higher than Exxon would likely have achieved on a standalone basis. We realize that hitting this target will not be simple, recognizing both the size and the complexity of our businesses. Lou and I are both convinced that within our organizations, we have the right people with the vision, talent, and expertise to ensure that this goal will be met, probably better and faster than either of us might imagine. Now let me wrap up with some summary comments on our expected timetable for completing the merger. In this last chart, we've listed attributes of our two great companies which will combine to make this merger a success. Much of what you see I've already covered, so I won't go through each point. I do want to emphasize that the success of this merger is not created on paper. It is created by people working together to make it happen. Assimilating two cultures is not easy, but I believe that our organizations have a common commitment to quality, as well as common values and similar approach to conducting business. This compatibility will help to smooth the transition to a new and effective organization. Another very important attribute is the wealth of best-in-class practices, which can be applied worldwide across all functions. Just sharing our capabilities and implementing the best will bring a sizable improvement in and of itself. Finally, something that is critical to us and important to our customers and the communities in which we operate is our common dedication to product quality customer satisfaction, and most of all, our commitment to safety, health, and care for the environment. Most importantly, we believe the merger offers a unique opportunity to enhance both Exxon and Mobil's shareholder value by capturing identified synergies and improving our capital productivity. Before turning the podium over to Lou, I'll note that from a timing standpoint, both Exxon and Mobil expect to mail proxy materials to our shareholders by the end of the first quarter of 1999. Following approval from the various shareholders and various regulatory agencies, we are aiming for a closing by the middle of next year. With that, I'll now turn this over to Lou Noto. Lou?
Good afternoon. As is typical in events like today's, Lee and I are getting a lot of attention. A lot of people are congratulating us, but the fact is there are many people in both our organizations who've worked very hard over the last few months to make today possible. I wish I could introduce them personally. I'm proud of the way the team on both sides worked, and I think it augurs well for the success of putting these two great organizations together. Today's announced combination does not mean that we could not survive on our own. This is not a combination based on desperation. It's one based on opportunity. But we need to face some facts. The world has changed. The easy things are behind us. The easy oil, the easy cost savings, they're done. Both our organizations have pursued internal efficiencies to the extent they could. Prices are low today, but that's not why we're here. We've never really had protracted periods of high prices and high margins in our industry. We tend to do the smart things when things are tough, and things are tough right now. We managed to pass on to the marketplace in terms of better quality products and lower prices most of the efficiencies that we can generate on our own. So all of us are now looking for some way to make a jump, to make a quantum leap, to be able to deliver more value to our shareholders and our employees and our customers than we've been able to. Neither Lee nor I are interested in size. I have no interest in being the largest company in the Fortune 500. Revenues mean nothing to me. What counts is profit, and what counts is the return that we together can generate for our shareholders. And that's what this marriage is about. We don't like size per se, but let's face it, a broad capital base, the ability to manage capital better, to spread risks, to undertake large, complicated projects like the kinds of projects that this industry will be faced with in the future if we're going to deliver a constant and plentiful supply of energy to the world. Today, surpluses are one thing, but we can't close our eyes to the fact that that's our mission. Economies depend on our products to grow. People use them to meet their own aspirations and to satisfy their lifestyle issues. This industry's here. It does a good job, and it's going to continue to be here and be an important and profitable one, hopefully. We also need to face facts that competition has changed. Today, we've seen the international majors make some rather bold moves. Shell and Texaco have joined in the U.S. downstream business. BP and Amoco have joined on a corporate basis. Other companies like the Venezuelans, the Saudis, who are large producers in their own right and have much bigger reserve bases than any private companies, are moving downstream. They're doing interesting things. They're becoming more competitive. They're becoming more of a force. National companies like Eni, the French, taking steps to be more efficient, more international. And that's why we're here. We're here because we're trying to respond to these changes, and we're also here to try to take advantage of opportunities from our shareholders. We did not run into this arrangement. From Mobil's side, we looked long and hard at our alternatives. What was the best way to meet these new challenges? We looked at acquisitions. We looked at mergers of equals. And at the end of the day, all our analysis and our gut says that this was the best arrangement for the Mobil shareholder. And therefore, we're very proud to be here today. My shareholders will now have 1.32 ad infinitum. You like those numbers. Those are cute. Lee and I have already played the lottery number on that, so you don't need to worry about it. They will have 1.32 shares of this new company. And I'm personally convinced that not just today, but 5 years from today, they will be better off as shareholders of this new venture than they would have been had we stayed an independent company. I hope the Exxon shareholder will feel the same way. We think this is good for both of us. Now I'd like to say a few words about Exxon and about Lee. First of all, you folks have been publishing a lot of words about Raymond and I. Raymond and Noto get along pretty well. We may have different styles, but the fact is that we share a lot of goals in common. I'm delighted to be associated with Lee. I think it's going to be a good opportunity for us to get the best out of these assets and these companies that we can get. I have a lot of respect for Exxon. We've been fierce competitors over the years. We still are. But we like what they stand for. We share a couple of values in common. We both focus on performance. And when I say performance, I just don't mean bottom line. I mean how our companies operate, the ethical and environmental standards that they try to achieve, the health and safety standards they try to achieve, the quality of work environment and conditions that they provide their employees. They have a very good get-it-done attitude. They don't talk a lot, they do. And number three, they have a passion for excellence. And in the long run, that's what will be the difference between a successful and an unsuccessful company. Someone asked me this morning, is this a sad day for you? And I would tell you it is not. I'm personally convinced that it's a good day for our shareholders, for the majority of our employees who will have opportunities to work in this new company, for our customers, and really also for the United States. I'm delighted to be part of this adventure. I thank you very much for joining us today, and I understand that now Lee and I will be happy to try to answer some of your questions. So Lee, I would invite you to come up front.
Mr. Raymond, Mr. Noto, thank you for those comments. Before we open the floor and the teleconference to questions, for those of you who are going to participate with questions here in the room, let me just go over a couple of very quick ground rules. Because of the crowd we have today and because of the individual mics, we ask that if you want to be recognized for a question that you raise your hand. When you are recognized for a question, please state your name and your media affiliation. It's important in this room, since each of you have individual mics, that after you ask your question, that you turn your mic off. To turn your mic on, there's a little button that you press. When you get through with your question, press the button again, and that will turn the mic off. With that, we open the floor to questions. We will alternate questions between the floor and the teleconference.
Mr. Raymond, could you please tell us why, in your mind, biggest may be best?
Well, I don't think biggest is necessarily best, and I've never said that it is. I've always had the view that the objective is to be best. If in being best you also happen to be biggest, that's fine. But if you're not biggest, that's fine too.
Paul Florangis, CBS News here in New York City. What impact will this have on your customers? Will they see a change at the pump as far as the number of gas stations in their areas? What are we talking about here? And also your credit products. Will an Exxon customer be able to use their card at a Mobil gas station, vice versa? Can you explain that?
Well, it's a good question. We should have thought of that. No, let me answer that in a couple of ways, and then Lou might want to add. First of all, you have to understand a lot of those kinds of issues that I'm sure you're interested in are far beyond the level of detail that we've started to work out. But first of all, it is our intention to continue to use both Exxon and Mobil as brands, both here in the U.S. and around the world, because both of them are strong, and wherever it's the more effective way to market our products, that's the brand which we will use. In terms of the number of service stations in this area, that's ultimately an issue that's going to be debated and discussed with the Federal Trade Commission. And until we do that, I think it'd be inappropriate for me to make any particular comments on it. And lastly, I'm sure we're going to find a way, and we probably already have some people after this has been announced today thinking about how can we put together the Exxon and Mobil credit cards so they can both, so that a card can be used at both service stations. And I thank you for your suggestion.
Let me just add two things to that. Number one, just because we say we're going to use two brands doesn't mean we're going to keep two separate organizations. We're going to have one streamlined organization. We need to be efficient. We're not going to invent a new name for the chain nor for the company. Exxon and Mobil both are respected and have good brand values. And we want to take what's best from both and apply it to the whole. So if we have different technology on one side of the fence, we want to make sure, and if it's the best technology, we want to make sure we can use it throughout the whole business. And I'm going to have someone be able to answer that question by tomorrow morning.
Ron Scherer from the Christian Science Monitor. I'm sure in the coming weeks you expect a lot of challenges at putting this together. What do you think will be your biggest challenges at making this into a super corporation that works?
Well, I assume the challenges that you're basically referring to are either with the FTC in this country or with the European community. And obviously we've done a lot of analysis, but I think it would really be inappropriate for me to make any of those comments until we've had a lot of discussions with the FTC and the European community. It's our expectation that they're going to have a high degree of interest, and it's our desire that we're going to work with them to try and resolve whatever issues they have in mind as quickly as we can.
Yeah, you know, Lee, there's one thing. I've been seeing some copy saying that somehow or other we have combined a 22 to 23% share of the retail gasoline market in the United States. I wish we did in some respects. If you take our combined retail gasoline shares, and that's what you see on the street. I'm not talking about sales to factories. I'm talking about the service stations that serve customers around the United States. Together, I suspect the latest numbers we have are in the order of 13 to 13.5%. And frankly, even at that level, that would not be the largest marketer in the United States. The Shell-Texaco combination is around 14 to 14.5, and the recently announced BP-Amoco combination, I believe nationwide, is in the order of 10 to 10.5, although their presence is very strong and very good east of the Rockies. So I don't want these numbers to sort of get some currency that they really don't deserve.
Yes, hi. Jonathan Burr with Bloomberg News. Can you give us an idea of how many people you expect will lose their jobs because of this merger? And also, what sort of assets are you willing to discuss selling to meet antitrust regulations? Do you expect to have to sell some assets in order to meet these regulators' concerns?
Yeah, let me go backwards on that question. Yeah, we would be absolutely amazed, although pleasantly surprised, if the FTC said we did not have to rationalize some assets. Beyond that, I think it'd be very premature for me to comment about any specific asset. That's really the FTC's job. It's not my job. To go to the first question, and Lou, you may want to add on this, we've done a lot of work. Between us, we have about 123,000 employees worldwide. Less than 40% of those are in the United States. The significant majority of our employees are outside the United States. Our top of the envelope assessment, recognizing that we have not been able to get large groups of people to put business plans together, and probably will not be able to do so for some time, because of legal restrictions until we actually are merged. We would estimate there will be about 9,000 people of that 123,000 people that in one way or another will be redundant to the organization. And the expectation is that they will be spread around the world. Every corner of Exxon and Mobil in one way or another will be affected by this merger. You want to add something?
And you need to understand that that's something that we take very seriously. This is not something that we get any pleasure out of. These are good folks. They've worked hard. They've tried to make our companies as good as they could make them. But there are realities in life, and we have to face up to them. We'll try to do the process in as fair and even-handed a way as we can, and we'll keep you advised as we go forward as to what those numbers ultimately are. As Lee said, you need to understand that both with respect to the short-term financial prize that Lee described in his presentation, as well as the people and facilities, we simply have not been able, nor can we, sit down and do the same kind of analysis together that we would do within our own companies until this is a done deal. And I promise that we'll keep our people advised as there are developments. We know that there's a lot of nervousness, especially in my company, being the smaller of the two in this combination. And we respect that. We are concerned about it, and we'll try to do our very best to keep our people up to date as to decisions as they're made.
One more question from the floor, and we'll switch to the teleconference.
Suzanne Pratt, Nightly Business Report. Can you tell us, would this deal happen if oil were selling for about $20 a barrel right now?
Well, I sure wish it was. But the facts are, given how the industry has evolved over the last 10, 15 years, my answer to that would be yes. As I commented in my remarks, this is not a short-term business. This is a very long-term business. And the decisions we take, whether they be capital investments, which have lives in our business of 15 or 20 years, or even more in some cases, the kinds of prospects we try and pursue, which are multi-year and even getting access to some of our upstream opportunities, decisions as we're talking about today are not driven by the short-term price of oil. They're driven by our views of what the competitive situation is going to be as this industry moves forward. And the industry will be there, and it will continue to grow as the world economy grows. You want to go?
Let's go to the teleconference. The first teleconference question is from John Burke with Federal Filing Business News.
Hello, gentlemen. I just wanted to know when you guys expected to file with the Federal Trade Commission under the Hart-Scott-Rodino Act and also with the European Agency.
I'm sorry.
I didn't even hear the question. I'm sorry.
John, can you repeat that, please?
Yes, I'm sorry. I just wanted to know when you were going to file with the Federal Trade Commission under the Hart-Scott-Rodino Act.
Well, as soon as we can, and as a matter of fact, I think as we speak, we have some representatives down meeting with the FTC this afternoon.
Okay.
The next question on the teleconference is from Victoria Churchill, Bureau of National Affairs.
Hi, thank you very much. I know you don't want to get into detail about rationalizing some assets, but could you please give us at least a little insight? As you said, you'd be delighted and pleasantly surprised if there were no problems at all, but isn't it most likely to be in refineries or marketing?
Well, I think kind of a surface analysis wouldn't take exception to that, but as I comment, I don't think it's appropriate for either of us to, and we've been cautioned by our advisors to not make any comments in this area until we've had a lot of conversations with the FTC.
Thanks.
Okay, the next question on the teleconference is from Dwight Silverman, Houston Chronicle.
I want to push a little bit more on this issue of possible divestiture and rationalizing of assets. There was plenty of speculation before this happened that you would come to the table in your initial announcement with an offer of what you might do. Why is the strategy there to not say anything at all with regard to shedding of some assets and let the FTC perhaps dictate to you?
I want to hear what you say to this one, Eddie.
I'm going to repeat the answer I gave to the prior question.
Again, this is more of a why question as opposed to a what. In other words, why?
Yeah, but in this world, whys are not exclusive of whats. I mean, to be candid about it, I'm not interested in your views on how we ought to deal with the FTC.
Can I add one thing to that? If you get past this period and you look at the two companies together, they're done. If you look at the track record of both companies, in terms of high grading their asset base, you should feel comfortable that to the extent that we have done what we have to do to get this thing put together and to create one new company, this company will strive for excellence, will strive for profitability, and will simply not just sit on its laurels. So you should be comfortable that we'll do what's best for the shareholder once we can do it.
Next question on the teleconference is from Dave Feeling, KHON-TV. Dave?
KHOU-TV, also in Houston. The big question here for so many of the workers with both companies is job loss, and I know you have touched on that. But specifically when you talk about Houston being the center or the headquarters for the chemical operations, are the odds greater for a net job loss or a net job gain here in the Houston area?
I guess the answer to that is yes.
Yes, and in which way?
I don't know. That's the point.
I really don't know.
Well, when they give you an either or that doesn't make any sense, the answer is always yes. And then they can pause and think about, what did you just say?
We're just not really
We're not in the position to say that. The facts are that the Exxon Chemical Company is currently headquartered in Houston. A good share of your chemical company is currently in Houston. We have not involved the chemical company, either one of them, in the conversation. So it's just way premature to make a judgment as to what the impact is going to be on the chemical company, or for that matter, the exploration company, or the producing company, or the research company.
The fifth question from the teleconference is from Richard Hydorn with the Philadelphia Inquirer. Richard?
Well, I guess you've probably just answered my question. I was going to ask about whether we would expect to see a greater or lesser impact on the Mobil jobs in South Jersey, your 1,000 jobs at your technical center in Paulsboro. You're talking about a 7% net reduction in workforce. Would you expect that the R&D program would be more heavily impacted by that than the average?
To be honest, let me try to answer this. Right. We really don't know. I mean, there are real limitations as to what we can do and what we can plan to do until we get this combination blessed and completed. Those decisions will be looked at by the management team in the new company. Believe me, they are not cold and indifferent. They understand that jobs are important. They understand impacts on communities, and they will try to manage the process and still achieve what's good for the shareholder in the most equitable way they can. When we know answers to these questions, and we're not trying to stonewall, we just don't know. We can't really know. As soon as we know them, we'll get back to you, we'll get back to our people and tell you what's happening.
Thank you.
Okay, we're going to turn the conference back to the floor. Because of the hour, let's take two questions from the floor.
Yeah, this is Richard Waters at the Financial Times. As you aim for your target of what looks like 20% return on capital after 5 years, if I'm reading that chart correctly, how much of that $79 billion of capital do you think you're going to be able to employ profitably? I mean, you seem to be talking about divestitures of some size. Do you see a substantial shrinkage?
Let me answer the... First of all, if you're correct, you have to be technically accurate. What we're saying is it'll be 5% above what we would have been if, in fact, Brent price 5 years from now averages $19.30 a barrel, which is what the 1997 number was. Then you may have the right number. But I'm not very good at forecasting crude price. That's why I always like to come to these meetings, because you can tell me what the price of crude is going to be, and then I feel better. But so you understand the point is it's a delta, and the base moves. The second question on how much capital will be employed 5 years out, there are going to be two, I'll call it, conflicting trends. If we weren't continuing to have a sizable capital investment program, then you would gradually see that capital employed come down as we high-graded the asset base. On the other hand, we together have a capital investment program of about $15 billion a year, which may be 13 by the time we get all done, which is going to tend to offset and grow it on the other way. Net, I would say 5 years from now, we'll probably have more capital employed than we do pro forma right now. Having said that, the mix is going to be significantly different than we would now by what we bring into the portfolio and what goes out of the portfolio.
A good question.
A good question?
Easy one.
Lou?
Thank you. Paul Tharp, New York Post. In June, when you two got together first, who made the first move? Was this done at a hunting lodge under great secrecy, a ranch somewhere? How did it actually happen, and who went to whom first?
I have the answer to that. Lee and I have agreed that if you ask me that question, I will say he called first. And if you ask him that question, he will say I called first. And it was not in any sophisticated locale. It was a telephone call. It was in our offices, and it was all business.
Last part, could the two of you kind of stand up for the stills and shake hands or buddy-buddy a little bit? Or
No.
Okay, I'm
The
sorry.
photo op is over. We need media questions at this point.
There's a young lady.
Do we have
over here
one more question from the floor?
About the collapse, if we don't recognize her.
Thank you. I'm Robin Seidel from Reuters. Can you talk a little bit about the option to acquire, for Exxon to acquire 14.9% of Mobil shares? If that in case somebody else comes into the fray? And Mr. Noto, can you talk a little bit about your role as Vice Chairman focusing on international areas or?
Let me try to answer both. On the first one, Lee and I are committed to make this thing go. Now, our lawyers will make us sign a merger agreement which has 153 pages and has all kinds of provisions in it. Termination provisions, penalty payments, options, you name it. And you'll see that when the documents come out. Frankly, that's not the point. The point is that we're here to tell you we're going to try to do our very best, not just to put this together, but then to really turn it into an absolutely first-rate company. But you'll see the details of that when you see the documents. And I would be very hesitant to try to comment on the legalities of that piece of paper. I'm going to work for Lee. I've spent 36 years with Mobil, and believe it or not, for 32 of those years, I actually work for people, as opposed to just shareholders. And I think I can adapt myself to do that. I think Lee and I have a good equation, notwithstanding all the stuff that's been written about us. We do a Bear Act if you give us a moment, but I'm very confident that we'll have enough work to do to get accomplished what we want to accomplish, not just within our employees, but with our partners and with our customers around the world, that it'll keep us pretty busy. So I'm looking forward to it.
Let me make a comment that you need to understand, and that is, until we can actually finish this, each one of us has a job. Lou has to run Mobil, and I have to run Exxon. And that is a full-time job. And as soon as we can put it together, Lou's job is to make sure that the Mobil people and the Mobil business that comes is in first-class shape to integrate it with Exxon to make it the premier oil company in the world, which is what the objective is.
Now, excuse me, we're going to take a last question from the teleconference. The caller is Lisa Bintz with La Tresse. Lisa?
Yes, thank you. I would just like to clarify how this merger will be accomplished in Canada. Will Esso Interior be integrated to Mobil Canada, or will they be kept separate units for several years?
You have to talk.
That's one of those questions that we haven't gotten to yet. I understand all the interest in Canada, but until we have some more time to understand more details about the Mobil operation in Canada, it would be premature for me to comment on that.
Thank you.
Mr. Raymond, Mr. Noto, thank you very much.